Hold on. Pause for a second. If you believe you already missed the silver move, don't scroll away just yet. Because the moment everyone is cheering might actually be the least important part of what just unfolded. The silver didn't simply go up, it cracked. It moved so aggressively that it forced a sudden public repricing in one corner of the market, instantly, without preparation, catching a lot of very intelligent participants completely off guard. But here's the part most people are missing. Silver grabbed the headlines, yet the real opportunity may still be hiding just behind them. Because when a commodity moves this fast, the first thing that falls behind isn't the price, it's everything that requires models, approvals, balance sheets, and reporting cycles to catch up. And that delay is where the real advantage quietly forms. Today is Thursday, January 29th. The time here in New York is 10:06 a.m. Drop a comment with the time you're watching. I want to see just how global this discussion really is. Now imagine this scenario. You're focused on your own business, your life, your routine, and suddenly silver pushes through $100 an ounce. Not a quick spike, not a blink and miss print on a chart. It breaks through and stays there long enough for the market to feel it. The first reaction is disbelief. The second reaction is excitement. And the third, if you're honest, is fear. Because when something moves vertically, the mind immediately asks the most dangerous question of all. Is this the start, or is this the end? That's why we need to slow everything down, zoom out, and then carefully zoom back in. Because the answer is not where most people are looking. The next clue isn't hidden in the silver price itself. It's buried in what the market still hasn't priced in. But before we go there, we need to understand how we arrived at this moment. Here's the cleanest way to frame this move without getting hypnotized by it. Silver spent decades trying to reclaim a single psychological level. Roughly 45 years passed before it finally clawed its way back to the old $50 peak, a level many investors treated as almost mythical. And once it finally reached that summit, it didn't pause to rest. Instead, it leapt off the other side, and somehow landed on an entirely new plateau. It felt like something inside the system shifted. So what changed? It didn't behave like a normal bull market. The move from 50 to 100 didn't happen slowly. Two powerful engines hit the accelerator at the exact same time. The first engine is silver is money. It felt like something inside the system shifted. So what changed? Two powerful engines hit the accelerator at the exact same time. The first engine is silver is money. Whenever confidence in paper systems weakens, human behavior becomes very predictable. People gravitate toward assets that can't be created with a keystroke. That instinct isn't ideological, it's ancient. And silver sits directly in that category. The second engine is silver as an industrial necessity. Not industrial as in a few consumer gadgets. Industrial as in the backbone of electrification, connectivity, energy infrastructure, and modern technology. Here's where things get interesting. Normally, these two engines take turns. One leads while the other follows. But recently, they've been pulling together. And when that happens in a relatively small market, price action doesn't stay polite. It catches fire. Now we have to talk about supply, because supply is where reality punches holes in comfortable narratives. Silver is not mined the way oil is. A large portion of global silver production is a byproduct of mining other metals. That means you can't simply turn a silver dial and flood the market when prices surge. You need copper, lead, zinc, and gold economics to align as well. That's why supply doesn't respond cleanly, even when prices are screaming. Recent market balance data shows repeated structural deficits. For 2025 alone, projections suggest a shortfall of roughly 95 million ounces. And since 2021, cumulative deficits approach 820 million ounces. That isn't theoretical. That's metal that had to be sourced somewhere, and that somewhere is inventories. This is where misunderstandings explode. People imagine vast warehouses filled wall to wall with silver and assume availability is practically infinite. But visible inventories behave like the pantry in your kitchen. If consumption consistently exceeds replenishment, the size of the pantry stops mattering. Eventually, shelves start to show. And when shelves start to show, price doesn't wait for permission. What tightens this even further is that mine supply hasn't surged in response. Global production in 2024 came in around 819.7 million ounces, up slightly, but nowhere near enough to erase years of accumulated deficits. A price spike doesn't magically heal a structural imbalance. Now comes the debate that always lights up the comments. Recycling. A price spike doesn't magically heal a structural imbalance. Now comes the debate that always lights up the comments. Recycling. Yes, higher prices encourage more recycling. That's real. Scrap flows increase when price gives people a reason to dig deeper. But recycling isn't an unlimited tap. Some scrap appears only when products reach end of life. Some scrap appears only when products reach end of life. Some shows up when financial pressure forces selling. It responds, but it doesn't instantly fix a shortage built over years. Some appears when price finally crosses a psychological threshold. Some appears when price finally crosses a psychological threshold. It responds, but it doesn't instantly fix a shortage built over years. Now let's talk about privately held silver, the comfort blanket argument. And recent market behavior suggests this shortage isn't hypothetical, it's operational. Now let's talk about privately held silver, the comfort blanket argument. Yes, billions of ounces exist in private hands. Coins, bars, jewelry, inherited stashes, vault holdings. The argument goes that if price rises enough, it all comes back to market. That assumption breaks in one place. It assumes people are rational sellers. They aren't. That assumption breaks in one place. It assumes people are rational sellers. They aren't. Many people don't hold physical silver as a trade. They hold it as insurance, as peace of mind, as a personal reserve. Those holders don't sell because a number looks big. They sell when fear disappears, or when necessity forces their hand. So yes, some metal will return. Long-term holders will take profits. Dealers will see increased sellback activity. But that's not the same as unlimited supply. In fact, the higher prices go, the more resolute committed holders often become. Because the question shifts from should I sell to if this is happening now, what comes next? And that question makes the market dangerous. Now let's examine where demand is really coming from. Silver isn't a purely Western story, despite how it's often framed. Over the past year, physical demand from parts of Asia has intensified. Premiums that once seemed absurd are now being paid with. Silver isn't a purely Western story, despite how it's often framed. Over the past year, physical demand from parts of Asia has intensified. Premiums that once seemed absurd are now being paid without hesitation. Gold substitution plays a role too. When gold becomes inaccessible for average households, silver steps in, sometimes as silver jewelry, sometimes gold-plated silver, fulfilling cultural demand at a lower price point. There's also a quieter shift happening. In some regions, silver is increasingly treated as acceptable financial collateral. That doesn't mean everyone is borrowing against it, but it does mean silver is becoming more integrated into financial infrastructure. Then a third lever enters the picture: refining. Mining and refining are not the same thing, and silver refining capacity is highly concentrated. One country controls an estimated 60-70% of global refined silver output. That's a choke point. And choke points turn markets political very quickly. You may hear noise about export rules and price-setting power shifting. Some of it is exaggerated, some of it is real. The key takeaway isn't short-term headlines, it's structural leverage. You may hear noise about export rules and price-setting power shifting. Some of it is exaggerated, some of it is real. The key takeaway isn't short-term headlines, it's structural leverage. When refining is concentrated, influence doesn't require dramatic bans. It operates quietly through prioritization, licensing, inventory management, and throughput decisions. Now zoom out to one of the most revealing indicators in the market, the gold to silver ratio. When silver sleeps, the ratio stretches. When silver wakes up, the ratio collapses. Recently, it collapsed violently, falling from triple digits to below 50 in a shockingly short window. Silver is no longer being treated as an afterthought. That tells us something important. When silver wakes up, the ratio collapses. Recently, it collapsed violently, falling from triple digits to below 50 in a shockingly short window. That tells us something important. Silver is no longer being treated as an afterthought. But ratios aren't destiny. They're conditions, like weather reports. They describe the environment, not the exact timing of what comes next. This helps explain why silver feels like it came out of nowhere. Gold can rise quietly for months. Silver can sit still for years, then move like a runaway cart down a steep hill. But momentum isn't inevitability. Targets like 125, 150, even 200 aren't fantasy on a spreadsheet. Ratio math supports them. What's deceptive is the path. Silver doesn't move smoothly. It spikes, punishes, consolidates, then spikes again. That punishment is why most people miss the full move. So here's a grounded framework. If your plan is, I'm buying because it's up, you're late. So here's a grounded framework. If your plan is, I'm buying because it's up, you're late. If your plan is, I need strategic exposure sized responsibly, you're still early enough. Allocation thinking matters. You don't need to buy everything today. Start with a fraction. Leave room to add on weakness instead of chasing strength. That approach doesn't promise profits. It prevents panic. Now let's talk about something most people ignore: invisible inventory. Silver inventory is fragmented across exchanges, warehouses, and reporting systems. Metal moves between them. One pile grows while another shrinks, creating the illusion of abundance. But the real question isn't whether metal exists somewhere. It's whether it's available at a tolerable price, in the form industrial users need, on the timeline they require. Headlines don't power factories. Deliverable metal does. Now consider financial products. Headlines don't power factories. Deliverable metal does. Now consider financial products. When both are active, silver goes from boring to terrifying. New vehicles that offer simple silver exposure pull in capital that would never touch physical metal. That money moves fast. Industrial demand is the floor. Financial demand is the accelerator. When both are active, silver goes from boring to terrifying. Could refining capacity expand elsewhere? Eventually. But eventually in commodities can take years, and markets don't wait politely. Which brings us to the question everyone asks. What happens next? 2 words, whiplash risk. What happens next? 2 words, whiplash risk. Silver is infamous for violent corrections. Even in powerful bull markets, drops of 15%, 20%, even 30% are not anomalies. They're features. History doesn't show a staircase. It shows a jagged climb. So a pullback wouldn't invalidate the story. The real question is whether a pullback is a reset or a top. And that answer lies in what most people aren't watching: mining valuations. Here's the uncomfortable truth. Even with silver at 100, many mining models still assume far lower prices. Analysts use conservative long-term averages. They haircut excitement. They avoid building models on prices that might reverse. That means equity valuations can lag reality. Not every miner is cheap. Some are priced for perfection. Some carry serious risks. But as a group, repricing happens slowly through reports, revisions, and cash flow visibility. And that repricing doesn't happen during euphoria. When quarters print real numbers, it happens during boredom. When guidance shifts, when balance sheets strengthen. It happens during boredom. When quarters print real numbers, when guidance shifts, when balance sheets strengthen. When cash flow becomes undeniable, that's when bidding begins. That's when bidding begins. So if you think you missed silver, consider that you may have missed chapter 1, not the whole book. If you're new, going all in at peak emotion is the worst move. Starting small and staying flexible is survival. If you already have exposure, strategy matters. Physical metal, producers, developers, explorers, each behaves differently. And right now, the debate is forming around producers and developers, where lag, leverage, and valuation disconnects still exist. But developers carry real risk: delays, costs, politics, execution failures. High prices don't erase reality, they just change incentives. And those incentives are already shifting. M&A is accelerating. Cash flow is becoming oxygen. Financing terms are improving. Capital is moving. That's how cycles evolve. M&A is accelerating. Cash flow is becoming oxygen. Financing terms are improving. Capital is moving. That's how cycles evolve. And the biggest mistake right now is believing the silver price tells the whole story. It doesn't. Price is the headline. Cash flow is the plot. Valuations catch up last. Train yourself to think in that order, and you stop chasing. I'll see you in the next one. It doesn't. Price is the headline. Cash flow is the plot. Valuations catch up there last. Train yourself to think in that order, and you stop chasing.